Good morning, and thanks for tuning in this Friday to Stocks to Watch on BloombergQuint. I'm Mathew. My guest today is Siddhartha Khemka of Motilal Oswal. Thanks so much for joining me, Siddharth. Good morning. And first of all, wish you, your team, and your family a very happy Diwali from all of us here at BloombergQuint. I want to start with the first of the three stocks that we've picked, and all three stocks happen to be on account of earnings. The first one is Eicher Motors. The revenue came in 3% lower at 2,134 crore rupees. The net profit is down about 40%. The margins have come in at 22.1% compared with 24.7%, but better than estimates at 19.8%. So, your view on the results, your view on the two-wheeler space and on Royal Enfield therein, and also the issues of the supply side, which seem to be building up for Royal Enfield in terms of their order book just keeping on growing. How does all of that stack up for you?
Yeah, Alex, very good morning and warm greetings to you, your team, and the viewers. Wish everyone happy and prosperous Diwali. Coming to Eicher Motors, yes, the numbers were marginally above estimates, mainly on back of the EBITDA margin beat. If you look at the overall demand, Q2 had healthy demand after a while, and demand has been healthy across tier 2, tier 3 cities. With the pandemic now receding, especially in India, we are seeing the demand in tier 1 also coming back. With respect to the overall production, Royal Enfield is ramping up production as a lot of the supply chain issues has largely been resolved. Production at the end of the Q2 was back to the pre-COVID levels. Current capacity is about 1 million units, which the company says can increase at about 5% per annum and can go to 1.2 million units without any further capex. Now, some of the recent initiatives that the company has taken is that the launch of new BS6 models, which has helped Royal Enfield achieve technical parity with some of its peers. And to take that further, they have launched the Studio Store, which substantially increased its reach in newer markets. So we believe that Eicher Motors uh, will sail through the current tough times on back of a solid balance sheet and cash position, a robust business model, a strong new product pipeline, a good retail footprint, and an exceptional management team both at the Royal Enfield as well as the Volvo Eicher business. What we believe is that with the launch of BS6 motorcycles, the technical parity with other high-end companies have been matched, and that is giving an inflection point to Royal Enfield as a completely new, improved platform. So, hence, we believe that there's a good growth that can come by both in the domestic as well as in the export market, and hence, we believe that's a good company to continue to look at.
Mhm. Understood. So there's still a buy rating on Eicher Motors despite the kind of price rise that you've seen, which brings me to the second counter, Siddharth, and that is Grasim Industries. I know that a lot of people will look at the numbers, especially at the margins that have come in at 11.6%, significantly better than estimates, which were 8.08. It came in at 11.6%, and that has sort of improved the net profit performance. Though it's down on a year-on-year basis, it is much better than expected. But the other thing to look at, Siddharth, will be the sale of the fertilizer business, which has been approved by the board to Indorama India for 2,649 crore rupees on a slump sale basis. And that business contributed just about 3.5% of total consolidated turnover. So disinvestment of that business, and coupled with that, the capex guidance being revised upwards to 1,852 crore. What do you make of that, and what is your rating on the stock?
Yeah, Alex. So Grasim, there are multiple factors at play here. First thing is the announcement on the sale of the 1.2 million ton per annum urea business for a cash consideration of about $350 million. So that is marginally positive, but as you rightly said, it is just 3% of the business, so a small business being hived off. brings back focus to the core business and also brings in cash. As we see that net debt of the company currently stood at about 23.3 billion at the end of Q2, which is still high, although it has come down from about almost 30 billion rupees at the end of FY20. So that's marginally positive. If you look at the numbers on overall, numbers have been pretty weak. The only thing is that margins have been higher than expectation. Volumes, to some extent, are likely to be under pressure. In the core business, that is VSF, revenue declined 11%, EBITDA was down 31%. In the chemical business, the revenue was down 16%, EBITDA was down 32%. And in this environment, still the company has guided for another capex. So an overall capex of about 18.5 billion for FY21. So we expect that return ratios will remain weak in the near term. Even in FY22, we are expecting around 2% of ROE due to the overall pressure in margins, both in the VSF and chemical business. And that apart, higher depreciation and interest cost on account of capacity addition. So hence, there's not much of growth in the EPS that is expected over the next 2 years because of the depreciation, interest cost, and margin pressure in the core business. That apart, it's a holding company where you don't get much value. You would directly play an Ultratech if you want to play the cement business. Some of the other listed entities do put pressure, for example, AB Capital, Vodafone, Hindalco, Aditya Birla Fashion. So net, we have a neutral rating and would rather place some of the direct holding companies, be it an Ultratech or a Hindalco or a Aditya Birla Fashion in their respective spaces.
Understood. Which brings us to the last counter, and that's an interesting one to talk about purely on the basis of the commentary, right? Phoenix Mills, the revenue is coming in at 48% low, and that's understandable considering that Q2 was a time when a lot of them major properties were under lockdown because of the pandemic. Net loss has been reported at 36 crore rupees, and EBITDA margins have come in much below expectations, Siddharth, at 42.7%. But at the same time, there's hope in Q3 that things have opened up. Especially around the festive season, there might just be people going out again. What is your view on Phoenix Mills, therefore? Would it be a buy for you at this point?
Yeah, Alex. So definitely the numbers were nothing to talk about. Revenue is down almost 50%, although they have improved on a sequential basis, up 60%. Margins remain under pressure, obviously, because as you rightly highlighted, malls were closed. It was gradually opening up. And on the net level, the adjusted PAT, it was a loss of about 359 million compared to an estimate of about 136 million. So the numbers were really nothing great. But what we make out of the operational performance is something that we like. On the status of the opening of the malls, most of the malls are now opened. All the malls are under operational. The overall area under operations now stands at 92% at the end of October. What we are seeing is consumption in Q2 on a like-to-like basis was 40 to 55%, mainly due to the restriction in timing when the malls reopened in Q2. But now those timings are, as we see, even in Mumbai, from 7 p.m. the timing has been increased to 9 p.m. And that is where they are benefiting. So we believe that Phoenix Mill is one of the best proxy plays in India's consumption story. And given the current impact on the numbers and the stock price, the risk reward is much favorable, and hence we maintain a buy on the stock. So we have a positive view despite the numbers, but on the things opening up and looking good.
Absolutely. On that note, Siddharth, thanks so much for joining me, and once again wish you and everybody with you a very happy Diwali. And to all our viewers who are tuned in to Stocks to Watch, thanks so much for tuning in. There's lots more, of course, coming up in just a short while, but wish you all a very happy Diwali and have a fantastic weekend.